So you want to start investing in the stock market, but every time you begin searching online for guidance on how to get started, you're bombarded with an overwhelming amount of information about buying stocks. Articles mentioning company revenues, earnings per share, EBITDA, and on top of it, you come across news about large companies going bankrupt. This often stops you from looking further. But worry not, in this video, I will show you how to safely and easily invest in stocks. You might ask, how is that possible? Well, it's all thanks to the help of index funds. In this video, I will explain what exchange-traded funds or ETFs are, the different types of ETFs and how they vary, how to select the best ETFs, and most importantly, how you can easily and securely participate in the stock market and build long-term wealth using stock ETFs. What are ETFs and how do they work? ETFs or exchange-traded funds are investment funds that are traded on the stock exchange, just like individual stocks. They are designed to track the performance of a specific index. For example, the S&P 500 index tracks 500 of the largest publicly traded companies in the United States. If you invest in an ETF that tracks the S&P 500, that ETF will buy shares of those 500 companies. As the value of those companies goes up and down, the ETF's value will also change in the same way. What this means is that when you buy one share of the S&P 500 ETF, you are essentially buying very small portions of 500 of the largest companies in the United States. The terms index funds and ETFs are often used interchangeably, but there is a difference between them. While a fund can track an index without being exchange traded, an ETF specifically refers to an exchange traded fund. This means that you can only obtain the index fund directly from the fund company and its price is determined only once per trading day. While ETFs are available on the stock market and you can buy or sell them at any time while the stock market is open. When people talk about ETFs, they are usually referring to stock ETFs. However, there are also other types of ETFs that serve different purposes. For example, there are bond ETFs and money market ETFs. There are also ETFs that are related to raw materials or those that combine various types of securities. In this video, I will be using the terms ETFs and index funds interchangeably to refer to exchange-traded funds. Now, the goal of an ETF is to match the performance of the index that it is tracking. It doesn't try to outsmart the majority of investors by picking specific stocks. Instead, it simply aims to follow the index and achieve the same results as the index. By investing in an ETF, you can easily and affordably participate in the ups and downs of the stock market, just like the majority of investors. The companies included in an ETF are reviewed several times a year. If the composition of the index changes, the ETF also adjusts its holdings accordingly. This way, the ETF stays in line with the latest developments in the stock market. Low fees and improved performance. You see, instead of having a fund manager who handpicks individual stocks, which can be expensive, ETFs simply follow indexes or specific sectors, and this strategy comes with some fantastic benefits. First, ETFs are cheaper compared to those fancy active funds. You don't have to worry about paying those hefty commissions when you buy or sell ETFs. In fact, in most cases, the ongoing cost of ETFs can be lower than 1/10 of what you'd pay for active funds. This means more of your hard-earned money stays in your pocket from the very beginning. So not only ETFs save you money, but they also allow you to keep more of the actual performance of your investments. With lower costs and fees, you have a better chance of maximizing your results. On top of that, most actively managed funds struggle to consistently outperform the general public. What are the different types of ETFs? Index funds or ETFs have different approaches when it comes to replicating a stock index. There are two main types of ETFs, each with its own characteristics. Physical ETFs. These ETFs simply buy the stocks that are part of that index. They are popular among investors because they are transparent and easy to understand. Investors always know which securities they are investing in, although sometimes the ETFs may hold optimized selections of stocks instead of all of them. Synthetic ETFs. Instead of buying individual shares, the ETF provider can guarantee the desired performance through an agreement with a bank. In return, the bank receives a basket of well-known stocks from the ETF provider. This arrangement can be cost-effective for both parties involved. Additionally, ETFs can also be characterized based on how they handle dividends. Distributing ETFs. When a company earns profits, it can distribute them as dividends to its shareholders. In the case of ETFs, these dividends are first received by the fund and then passed on to the investors. This distribution reduces the value of the fund but gives investors the flexibility to use the dividends as they wish, such as taking advantage of the saver's allowance. Reinvesting ETFs. Alternatively, an ETF can reinvest those dividends into the fund itself. These are known as accumulating ETFs and are suitable for long-term investors aiming to build wealth over time. The reinvested dividends along with positive performance can compound over time, similar to the compounding effect. These different types and approaches provide investors with the choices to align their investment preferences and goals with the ETF that best suits them. What are the best ETFs to invest in? This statement is very subjective, as the best ETF can change depending on your goals. For example, if you want to invest in only those companies that provide dividends, then probably SCHT with its approximately 3% dividend yield and 0.06% expense ratio might be a good option. On the other hand, if you only want to invest in the IT companies, the S&P 500 IT sector could be the best ETF for you. That being said, the best ETFs in my opinion are number 1, MSCI World ETF. This ETF consists of 1500 companies from developing countries. Number 2, MSCI Emerging Markets ETF. This ETF consists of 1300 companies from emerging markets. And number 3, S&P 500 ETF. This ETF tracks 500 of the biggest companies in the United States. Please hit the like button if you're getting value from this video and consider subscribing. Now, when you search for these ETFs on your broker app, you will come across a lot of ETFs having similar names from various providers. Who is behind the ETFs? ETFs are usually launched by banks and specific fund companies. In Europe, the largest ETFs are from iShares, which belongs to the US-based asset manager BlackRock. There are also ETFs by Amundi from French credit Agricole, Xtrackers, which is majorly owned by Deutsche Bank, and Invesco from HSBC Bank. How to select an ETF? The most important factor when you're searching for a suitable ETF is how long has this ETF been available on the stock market. Any ETF that is younger than 5 years or has less than 100 million euros in investor money shouldn't be selected. The age of the ETF helps us figure out its performance and see if the ETF has actually matched the performance of the underlying index. A certain investment volume is also necessary in order not to risk the ETF provider taking the index fund off the market because it's not worth it. Another important factor is the running cost or total expense ratio. Even though ETFs are passively managed, there are still some costs associated with them. Ignoring these costs can definitely cut into your profits because even a 0.1% difference can make a huge difference in the long run. For example, the MSCI World ETF from iShares has a total expense ratio of 0.2%, while the MSCI World ETF from Amundi has an annual cost of 0.12%. In the end, what matters is that the ETFs after cost comes close to the performance of the index it is tracking. How and where you can buy ETFs? If you want to buy ETFs, you don't have to go to the bank or contact a broker. You can save yourself the fees that banks often charge for securities account. Instead, open a free online investment account with an online broker. I recommend opening an account with Scalable Capital where you can buy and sell ETFs very cheaply. The account opening process is very easy. Simply use the first link in the description to sign up with Scalable Capital by following the simple steps. There is always some sort of promotion running, which I will also mention in the description. Once the registration is complete, you will have to verify your identity. This process can be done completely online in most cases. Buying ETFs made easy. Once you have opened the broker account, figured out which index fund you want to invest in, all you have to do is search for it. Simply go to the find option and search by writing the name, ISIN or the WKN. For example, when you search for the MSCI World, you will get the following results. You can select one of these and check the details. For example, its daily, weekly or yearly performance. Check out the ISIN or WKN, find out the details about the fund manager, and most importantly, check out the total expense ratio or the costs. In our example, the TER is 0.19% per annum. You can also verify if this ETF fulfills the requirements I mentioned earlier, like is this ETF accumulating or distributing, synthetic or physical, and since when has this ETF been running. If you are satisfied with the requirements, you can buy it during market open hours or set up a savings plan. I have a detailed video on Scalable Capital here if you want to know more about how it works. When it comes to how much money you should put while investing in ETFs, you have choices. You can either invest a large sum all at once or opt for a more gradual approach by saving smaller amounts on a monthly or quarterly basis through an ETF savings plan. This is also called dollar cost averaging. Here's the key. It doesn't matter when you start saving. What truly matters is that you stay committed to your investment in the long term. Whether you begin today or later, the important thing is to keep investing regularly and let your money grow over time. However, things get interesting when it comes to the time of exit or exactly when should you sell your ETFs. Imagine you have a specific goal in mind, such as needing your ETF savings in the next 10 years. It's not wise to rely on the assumption that stock market prices will be high at that specific time. Instead, it's advisable to gradually reduce your ETF assets by selling some of your ETF shares. This way, you can secure the gains you've made and protect your investment. Once you've sold your ETF shares, you can consider parking the money in a current account or a savings account. This provides a safe place for your funds while you assess further investment options or prepare for your future financial needs. Remember, investing is a journey that requires long-term commitment. While the timing of your exit is crucial, it's equally important to stay consistent with your savings plan and make informed decisions based on your financial goals. But while you are investing, you might also have a question: how safe are ETFs? Here's the important thing you need to know about funds, including ETFs. The money you invest in fund shares is considered special assets and is protected. So no need to worry. Even if your ETF provider faces financial difficulties or goes bankrupt, your fund shares will still belong to you. The law requires fund companies to keep their customers' money separate from their own assets. They usually entrust this task to independent custodian banks. For example, iShare uses State Street Bank, while Invesco uses the Northern Trust. This separation ensures that if the fund company goes bankrupt, your assets won't be included in the bankruptcy state or used to settle creditors' claim. Instead, the custodian bank is responsible for managing the ETF either permanently or until another ETF provider takes over the fund shares. In the unlikely event that the custodian bank itself faces insolvency, the law mandates that the fund shares be transferred to another trustee who will serve as the new custodian. Rest assured, this situation should not put you at a disadvantage. Similarly, if your online bank or broker where you hold your securities account encounters difficulties, there is no need to panic. A trustee would step in to take over your portfolio and become your new point of contact. Remember, the protection of your investment is a priority, and the law has safeguards in place to ensure the safety of your funds. Now, ETF or index fund investing isn't the only option. You can also buy stocks of individual companies like Apple, Tesla, Google, and many others. In this video, I share how you can use paper trading to buy and sell without using real money. So thanks for watching Bleib Gesund, and I'll see you in this video.